Saleh, and this is episode 611, 12 of the Orange Pill Investor. And I forgot to change the title to Panic. The Panic Roll was right. Uh, I actually kind of waited a little bit too late in the day to demonstrate what I was going to show. But let's just take a look at ASST real quick. I guess you'll have to take my word for this. But when I talk about what are the reasonable returns on capital week to week, there's, if I sell at the money cash secured put, $16 strike, next week I can capture $90. That's like between 5 and 6% of the underlying price. So that's what I'm calling the weekly return. However, if we're trading at this price next week at this exact time, we can expect there to be $16 of value left in it. So you're not really going to be able to capture the full 97. You're only going to be able to capture 80, which is still 5%. But just keep in mind that you have to factor in the costs of these things. So that made me wonder, does it make more sense to close these at, closer to 4 p.m., maybe like 2 p.m. or even 3 p.m., unless you're trying to avoid exercise risk? If you don't want to be assigned, then you'd probably want to take care of this stuff at least before 2 p.m. Or 12 o'clock is probably even pushing it if some of these things are deep in the money. But it got me wondering, and even that paper that I covered, or the article, so far I've only read the article from Timo about short-dated Bitcoin calls being overpriced, which should also apply to selling puts. It's basically going to be, are the options more expensive? And if the answer is yes, does that also apply to Bitcoin derivatives, Bitcoin treasury companies? And if the overvalue basically increases the closer you get to zero DTE, are some trades possible on Fridays? I'm pretty sure this one was worth $20 earlier this morning. And like 5 minutes ago, it was down to like 12, I think, because Strive was trading around 16.15. And the reason why you would not want to do this is if the gamma exposure bothers you, because gamma is all the way up to 88. So every dollar that ASST changes is going to go up by this number, but then this number is going to fluctuate every dollar by this number. And so this is what they mean by gamma risk. Once you're getting close to expiration, this has a huge effect on the price of the option. And this is only 16 cents now, but if this was still trading at, a little bit above this, maybe 16.20 or whatever, and it was 3:59 p.m., then this would be worth nothing because it would be about to expire worthless. It'd be like a penny. But as soon as this bad boy flips to in the money, now it goes from being worth 0 to, I'm sorry, in this direction, selling the put. Yeah. Once the price went under 16, this thing starts to become worth, if it goes down to 15, this thing is worth $1, and it's basically dollar for dollar. So selling this for 16 and then the price drops down to 14 could cost you almost $2. So if that gamma risk is causes anxiety, then this would be a problem. But this morning when I looked at this like an hour ago, there was still like 20 bucks worth of extrinsic value left in this thing, which is 1% of the underlying price for less than one trading day. Prorating that out, that would be like 5% a week. 250 trading days a year, that would be like 250% returns. But you can only get 0 DTE, once a week. So really that would only, you could deploy some extra capital just on Fridays and capture this peak theta collapse in the last 8 hours of the trading week. But you'd be exposed to a ton of gamma exposure here. Again, everything in life, everything in options is a trade-off. Is this worth doing? For me, probably not, because I would have to either place the trade last night, right before the close, or as soon as it opened, just to get that full 8 hours of theta decay. And then I'd have to come back and like roll it at like 3:30 p.m. And for me personally, it's just not worth being in the market. But I mean, if you sit in front of your computer screen all day, this is something that's potentially worth looking at. The momentum traders are doing it, but they're actually buying the calls. And if the paper's correct and they're overpriced, as far as they're concerned, it doesn't really matter because they're playing momentum anyway. So they're betting like when a stock is testing a 52-week high or something, which this is not, but well, yeah, no, it's not a 52-week high, but yeah, I don't even know any good examples. But the momentum traders I know would watch tickers for when they're going to be on 52-week highs or 52-week lows. And if they were in price discovery for 52-week highs, then they'd maybe buy some calls and, try to double or triple or whatever. Take some profits. Or if it was 52-week lows and the damn thing was crashing, maybe they're buying some puts or whatever. I never really did too much of it or figured out how to make it work. But if they're buying them, the momentum traders probably don't care because they're overpriced when they buy them, but then they're also going to be overpriced when they sell them. So in a sense, that almost comes out in the wash, like living in your house and the price of your house goes up and you get a bunch of equity, like kind of that part that is kind of meaningless, because if you sell that house and buy another house, presumably the house that you're buying also went up just as much as your house did. So you're just kind of taking profits and sinking those profits into another overpriced asset. So I just thought this was kind of fun to look at. But yeah, I think the proper title for panic would have been better, because we're going to have some interesting rolls here, because it looks like we're trying to, we're either going to double top and come back down to earth, or maybe we get through 180. Earnings is next week, so I don't know that really matters. Probably the only thing that matters is Bitcoin, and I guess Bitcoin was pretending it was going to go down earlier this week, and we're so back, so now everything is coming back to life. I guess if you closed your cover calls here and then were scared to get back in, maybe you were rewarded with that if you timed that perfectly. But I'm gonna be having some fun trying to figure these out. I think I even rolled down for a credit that's going to cost me about at least 500 bucks. What's up, Sandeep? Sold today's strategy 177.50 calls. This AM got tested, just closed, made a small profit, but it was a little painful. Yeah, and you know, if I manage to get out from underneath these calls, it's not like skill. This is just all luck anyway. I don't have it on here. I wonder if it's on Robinhood. No. I could customize this and add a column here for probability of, oh, I do have probability of touch here. So this is how often you should expect your covered calls from getting, if they're out of the money, going in the money. And so yeah, like my 135 cash secured puts, 26, there's a 1 in 4 chance that we see 135 before May 29th. But again, these are all just estimates, and you got to wonder if the model that Timo described is accurate and Black-Scholes is wrong. Like, I'm sure these are all tied to certain assumptions. And so are these even correct? But the whole point of me highlighting this is just to give you a sense, like, you should expect your strikes to be threatened. These 150 puts that I sold, half the time, during the 30 days of this contract being open, I should expect this to come down and touch 150. Then maybe I diamond hands another week or two and it goes back up to 165. Or maybe I I hodl through that and it drops down to 125. As far as I know, there's no way to predict that kind of stuff, but it does give you a little bit of clarity on how often we should be expecting to have to deal with this kind of crap. This is 0 DTE, 167.50, 13% probability of touch. I think it would be 100% because this thing is already in the money. What's up, Buffalo? Great, joined late. I'm looking into Strive Leaps again, 128. You probably covered it. No, I haven't talked about them yet. What's up, NYC? Had to roll out to August 220 for defense. Longest DTE so far in years. Fuck my life. Yeah. Let's see, this is May, June, July, August. Yeah, that's as far as I can really think of that I would potentially roll. Theta does start to increase a little bit at 90 days, but it's not meaningful enough for me to be willing to roll out that far. I think 60 is probably my limit. And then I would just sit on my hands for like 30, 40 days. Try to capture some extrinsic value and then try again. All right, let's minimize that. Let's reshare without volume. Unfortunately, some notifications started. I never noticed them before. I didn't change my settings. And if I disable notifications, that was what was causing the errors and reloading. So I'm kind of stuck with something annoying that I don't like, unfortunately. But let's take a look at Tesla. So my Tesla covered calls are in the money, bigly. So that's fun. But there's 28 days left, so I'm not really too motivated to roll them. Well, let me just check. 370, they're $23 in the money. 32 minus 23 is 9. So there's $9 of extrinsic value here that I can capture if I just do nothing. So that is what I will do. Same here. What's probability of touch on this one? 90%. So there's a 90% chance they're saying that that in the next 35 days, Tesla will touch the butt and hit 400. But for me, I mean, this changes nothing. I'll just wait, collect some extrinsic value before I roll. And are these worth anything? Probably not. 20. Yeah, I'd have to take a 50% haircut on those. All right, nothing to do here. All right, here's the big one. I think I had the 170. There wasn't much left. Then I rolled down to 165 for this little extra credit. And now we're looking at 175. So I definitely got whipsawed on this one. I would have been much better off sticking at 170. So let's see what happens if I try to roll this just 1 week. I can roll up one strike, not two. So let's see if this is worth my time. So it's worth about 12. And there's $9 of intrinsic value here, which would leave about $3 of extrinsic value, which is 2% of the underlying, almost. So it's actually not terrible. So hopefully I'm not digging my own grave with this. Yeah, these stupid ass notifications down here are a pain in the ass. But I can't disable them or I get errors and have to refresh. So that's fun. And they don't want to give me a fill. All right, so I didn't roll out of the money. If this just keeps going up and up, then eventually I will have to cry uncle and give and pay for this somehow, some way. This one's got $1,600 of intrinsic. That leaves 600 extrinsic. I can let this cook for another week or two. No big deal. The synthetic. This one's not quite in as bad of a position. Let me just see what would happen if I try to close this. That would cost me $2,000. I can't remember what I got paid for this in the first place. And I can't remember how much premium I've captured. All right, let's roll to next week. Let's do one more strike up as well. I could do two. Let's see. If I roll here, this is worth about 11. $7 of extrinsic. That's capturing $4. If I roll here, this is about 950. That's 550. I'm just going to roll one strike. Capture a little bit of a credit here. No, of course, that's not going to fill. All right. Ungroup. Which one was this? Shit, I can't remember if this is one. That was the 167. My God, these things are annoying as shit. Okay, open the 170. All right. So far, the only rolling I've done has been for small credits. I've only been able to dig myself out of this in the money hole slightly. So this could get worse before it gets better. Or if I keep going long enough, maybe roll until you're right will work out. Now, I could use this as an opportunity to close. Or I could roll this up for a credit. But with this pumping, I'm tempted to take off a cash secured put. Let's take off at least one. All right, so I sold it for 11 days ago. Kept 230. So made a couple $100 in 11 days. That's about 1.5% of the underlying value in 11 days. So 1% a week. That's pretty standard. I did keep a little bit of profit. I could take the other one off. Yeah, let's take the other one off. All right, so that is reducing my exposure quite a bit. I've got these other two that are they were already a little bit more risky because they were higher strikes, but they too have gone from $8 to under 4. So I'm gonna close one of these as well. Um, actually, I'm gonna roll one. I'm gonna keep one. So I'll roll out to 48 DTE. Should I keep the 150? So the expected move is all the way down to 140. I could roll this up at least to the 155 strike. All right, captured a little bit more premium there. Do I want to close this one or roll it? I think I'm going to close this one too. If strategy comes back to life, then I'll sell a couple more cash secured puts on the down move. Even with this move, the 1080 is still a loser, loser, slight winner. This is up 20%, up 10% ish. So there are some profits that I can, some small profits I could take if I want to pay to, close these positions. It's not going to be enough. 60 delta here, that's probably only enough to cover about 3 of these contracts. So fun times. All right, I decided to put this one on yesterday. Captured $1 basically overnight. Putting up what 4,400 as collateral. Captured 2% in 2 days. Not bad. Let's roll to next week. Just gonna roll right up to, what's the price? Right up to at the money. All right. I thought that one had a chance of filling. Here we go. And Cypher. These have only, let's see, this one's only been on for a day. This one's been on for 2 weeks. It's only captured about 20% of the move, or excuse me, of the original sale price. So I think I can let those cook for another week. I just rolled these, and I think I closed. No, these were, I think I left these alone. I think I had 60 of the other ones. Rolled 40 and used that to pay to close. 2 more. I'm deleveraging this account. I know that it says that this is positive, but if I added up how much it would cost me if I got assigned on these, so basically 60 positions, let's just say at $15. 10 positions, 15 each would be 15 grand times 6, 90 grand. So it would cost $90,000 just to take assignment of all of these positions. So this is kind of a sneaky way that I'm using a ton of margin, but I'm not paying for it. I'm not being charged margin interest here because I'm using the cash secured puts. And oddly, like Tasty Trade must have a weird ass algorithm, because oddly they would let me take up, like, maybe not in Cypher because it's the same position, but let's just look and see how crazy I got to go with this before they don't like it. Like, how many more of these? Let's do like 100. Yeah, they would let me take out 100 more of these, which would be 100 at the 15 strike, would be like another $150,000 of obligations. That's ridiculous. I don't understand how that's not a concentration risk. Make sure okay, there we go. 200 did it. See, buying power reduced by $265,000. But meanwhile, they're okay with, I have to make sure I do not fucking double click that. But that would be an insane amount of leverage. Now, let's see what they would do for the weeklies. Weeklies probably have a lot more risk in them. They're going to let me do it still. So basically, oh God. Basically, they're saying, sure, go ahead and plow $100,000 worth of obligation. Wait, 1,700 times, that's $170,000 worth of obligation. But making 10 grand a week's kind of tempting. Yeah, I don't know. I can't bring myself to do it. Yeah, Robinhood. I don't know. People go broke on their Robinhood accounts too, but I think it's a bunch of degen option buyers. But man, Tasty Trade will give you enough rope to hang yourself with. I felt queasy when I had 80 of these contracts, and they're gonna not bat an eyelash for me to add another 100. It's kind of crazy. I wonder if I add another ticker, if they'd let me add even more positions. Let's go to the expected move. Let's do 200. Yeah, they'll let me do 200 positions. Fuck me. That's crazy. That is crazy. Yeah, I thought I was playing with fire, which possibly am. But I guess I guess I'm less irresponsibly long than I thought. With my one iron cash secured put, my one iron weekly that I put up here. Crazy. Crazy, crazy. What's Tesla? What's Tesla paying? That's right. Tesla's got the 3 times a week. So Tesla's paying $340 just from today to Monday. So that's almost 1% in one trading day. Getting to Wednesday, 1.5%. Going to next Friday, basically 2%. So 2% weekly returns at the money on Tesla. That's 100% returns with no upside. It's not bad. And extremely risky. Like Tesla could go to 300 in a month, or it could go to 400, 500, whatever. I know I'm talking about this nonchalantly, but it's not free money, and which is why I'm not doing it. I do just like to see. I do like to look at the possibilities. But let's just say that Bitcoin, bounces off of 80 again. Yeah, we hit 80. Let's say we get rejected by 80 again, and now where are we going? 70? Yeah. And then we're going back down to 70. At least taking off some of these positions will let me put some positions back on. And so if Bitcoin drops to 70, strategy drops back down to 125, Cypher drops back down to whatever, 15, 14, then I'll be able to add some cash secured puts at lower prices and capture some bigger discounts. So, don't know if that will happen, but it's probably a good time to talk about Quick Fingers Luke again. He was the shitcoin the shitcoin trader. He turned a shitcoin trader from a penny stock trader, and he said that you always participate in the bounce. So if you're long and the price goes up, you have to trim that position. And it's the hardest thing for Bitcoiners, I think, to understand, because you don't have to do that with Bitcoin. But if you're fucking around in the stock market, you have to build that in somehow. I mean, you can do dead man's portfolio, that's fine. But if you're trading with any frequency, then you have to pick your spots. And so, you know, that's, removing some of these, taking some of the profits, and then reducing the number of contracts, which would allow me to add more contracts later. But the question is then, what do I do with the cash? The good thing about the prefs is now that, strategy is up, with, and when I say up, like obviously it's still down 70% off all-time highs, but it's up over the last month. Tesla is also up. So that bumfuggles my pairs trade of being able to, like, oh, if Tesla's up, I'll trim some and add strategy, and if strategy's up, I'll trim some and add Tesla. Well, they're both up, so now what the hell do I do? Um, I I will probably, I don't know, if I have to pay bills in 2 weeks, I'll probably just use this cash anyway. But I could just buy some theta or stretch as dry powder. Theta's on sale because it just paid the dividend. So you can get basically a 1.5% discount buying them now. And then if it gets pushed up to par over the next month, you can make that 1% back. I would say, oh, and then you can get another percent from the dividend. But if you hold through that dividend, it's just going to crash a buck again, potentially. Which in my wife's account, I've started just stacking them and not selling them. I was kind of doing the back and forth thing, but it's a little bit of a pain in the ass. What's stretch trading at? Did stretch go back to par? I don't think it did. Not in the last couple of weeks, right? It's close. Yeah, this is when it paid the dividend, right? Yeah. So it dropped a buck. It dropped, the low was down to 98.95. So it's taken about 2 weeks to try to sneak back up to par, which, yeah, I'll probably log in and vote for them to do the twice a month thing. But I don't know if it matters. I was excited about it at first. It's definitely exciting for people who are buying them and then dripping the dividends, because now you're going to get compounded 24 times a year instead of 12. that is significant. But if this was taking 2 weeks to get back to par, and then it sits at par for 2 weeks from, the first basically through the 15th, paying twice a month, is it just going to take a week to get back to par? And they're going to be selling. In either case, they're still getting 2 weeks a month to ATM. I don't know. Maybe it's a stroke of genius, or maybe it just doesn't fucking matter. I think I was getting a little bit too, I was overthinking it or being too smart for my own good, because I was imagining, like, why should the stock price even go down at all? Because the value of Stretch hasn't gone down just because they paid the dividend, because Strategy paid the dividend. So shouldn't Stretch just trade at 100? But of course, if it didn't dip at all, then people could literally just buy on X dividend date and sell it the next day, capture the 1%, and then Strategy's price would drop $20 a share or something. So that it does, I mean, it has to go down to penalize people trying to just capture the dividend and exit. But really, it didn't crash. Like, if you exited right away, it opened at 99.44. You could have dumped it, captured the 1% dividend, almost one, only lost a 0.5%, and then you could just take your money and run. So, like, yeah, it'll be fun to see what the twice a month thing does to this refractory period. But I don't know that it's, I guess right now people can get in for a day and then have their cash for 29 days a month. Now it's like, okay, you're only going to get half of that. And if you exit the next day, you're only going to be able to do whatever you want with your capital for 2 weeks. So maybe it disincentivizes the people jumping in and out of these products, which I think a lot of people were excited about Theta and Stretch being on opposites, because they could dip in and out of each one. But if Theta follows in their footsteps, and now they're both twice a month, and it turns into like a weekly thing, I don't think people are going to be able to get in and out of Stretch and Theta every single week and capturing dividends. I think that would just be a lot of work, and you'd be like arbing like maybe 1/4 to 0.5% a month. So divided up into 4, so that would be like, yeah, it'd be like 1/4% a week. I guess it would add up to like one a month. Yeah, I don't know. I don't think people are going to be able to do, but maybe if people will just put half their shit in Theta and half in a Stretch to get 4 dividends a month. Maybe that makes people happy. All right, so with that being said, I can get STRC. Maybe I do need to start building a Stretch position to fund and back my cash secured puts. Probably does make sense. I'm backing my cash secured puts with basically fucking air at this point. All right, so I can get Stretch at like a 10-cent discount. I would love to get Theta here and buy the dip, but Stretch is going to pay out again first, and you know what? My option buying power is kind of meaningless. Like, I would get a much better deal with my margin on Tasty Trade. I think Robinhood gives you the full theta discount for margin. Let's buy 1 share. Estimated cost is $100, but I thought it would tell you what your margin cost is. I don't see it. I've seen it here before, though. That's annoying. All right, if I buy 1 share. Yeah, this is what I was expecting to see. Did I just miss it? Maintenance ratio is 50% for STRC. Oh, here we go. Yeah, 50% ratio as well here. But unfortunately, Tasty Trade has not given the green light for this yet. But my problem in this account isn't the cash, or excuse me, isn't the buying power reduction. It's the cash itself, and they're both costing me the same. So I'll just actually buy this one. What do I need? Let's go 5 shares. I'll buy the dip. Cha-ching. I got filled at 98.58, which is a bigger discount to par than the dividend actually pays. So kind of can't beat that. All right, I think that's it for the main account. You're back in. You just sold today's strategy 180 calls. Try to pay for dinner tonight. Average sell 41 cents, trying to buy close to 20. Stretch payout day and record day will be the same day. That's huge. Really? I thought it was 2 weeks. That's changing? Am I behind on the news? All right, the IRA. Getting wrecked on the Tesla covered call. That's good news. Are any of these in profit? Close. I can sell these for 270. Okay. Yeah, I'm up like 10% on these things. Oh, because I've only had them for 9 days. These probably not. Trade price is 130. We're only worth 70. Okay. Same thing here. I'm getting wrecked even worse than I was yesterday. Been open for 25 days. $27 in the money. That means there's only $3 of extrinsic value left in this position. That's not quite 2%. So this is ready to roll. I'm probably not going to be able to squeeze much out of it. But let's roll to 48 days. And I'm going to roll this up as much as I possibly can and still get a credit. So it's only going to be up $5, but I'm trying to keep my head above water. And I will continue to try to do this until the price of this option comes back down to earth with the price of the stock. Not saying that 100% chance that will happen, but that's the goal. And if at all possible, I'm still rolling for a credit. So I'm not like rolling out to the 225 strikes and paying a huge ass debit. Actually, is the bid-ask spread on this one so bad that I can't get filled? Even for Tesla, that's pretty bad. Yeah, you know the bid-ask is bad when it's like ranging from a debit to a credit. Hmm. I think this keeps narrowing every time I roll this down, every time I adjust my position. There we go. So I still got filled for a small credit. I was able to increase the strikes $5. If I do end up having to roll for a debit, if it just becomes too, if I go out to like 45, 50 days and it's so deep in the money that I just can't roll for any extrinsic value, I'll consider taking off a poor man's covered call. And actually, I wonder if I should consider doing it now. That would be participating in the bounce. So if I take off the one that's the deepest in the money, because it's got the least room to grow, that'll give me 7 grand. Let's do that. It's going to reduce my leverage on this rally to strategy. I could just buy straight shares with that, which is what I did with this one lonely ass little share. Or all right, let me deal with this one. I got the 15 calls. Seriously? Let's see. Can I roll to next week for a credit? This is my IRA, so probably doesn't matter. But letting them get called away at 15, if I bought some Strive after that within 30 days, would be a wash sale rule. So maybe I try to avoid. Let's give that a shot. All right, what am I going to do? What am I going to do with 7 grand? Five cash secured puts. This is going to put me in the awkward position of selling puts above the strike that I have my covered calls on. That's like crossing the streams in Ghostbusters. Wow, that's kind of a lot. Yeah, maintenance excess $300. Let's do same. Wait, $500. What can I do with $500? Oh, I've got 10 shares here. So how many shares can I buy? Nope. How much do I have? Oh, maintenance excess is only $300. Okay. So it's about 20-ish shares. Let's do 18. That's better. I'm just going to keep adding shares until I get to 100. Then I can sell an extra covered call. Maybe I should probably sell this share of strategy. That'll give me another $170. I could get 10 more shares. I'll deal with that when I have to. All right, spending account. All right, my trade price on this Tesla is 250. This has got to be a losing position because I've had this on for quite a while. Yeah, practically break even. Probably this is about a break even as well. All right, play of extrinsic, plenty of time left. I just rolled this yesterday. Nothing to do here. Nothing to do here. All right, so there's only about 10-20% decayed from this in 2 weeks. So I'll let this cook for another week. All right, Strive. I sold the 16s. This is gonna, I'll close these for 10 cents. So let's roll them to next week at the money. Another $80. No fill. No love from the fill gods. I got notifications flying across over here. I got notifications over here. Fucking drowning in notifications. I don't need that many notifications. Please, K, thanks. All right, maintenance excess is up to 895 now. So, do I want to add to my theta position or my stretch position? Or trim one of them and add another. No, I'll wait for the prices to go down before I trim this to add a cash secured put. I think that makes more sense. I don't know. I've got 895. That is getting close to being able to sell another cash secured put. Actually, I can just do that instead. All right. No option buying power left. And if the prices crash, then I will be in margin risk again, which should be fine because I can just sell these positions, which is the whole point of stacking them. All right, I think that's it for there. Not quite seen it yet. I don't remember what the hell I was talking about. Record date for the next dividend will be the pay date for the previous one. I gotcha. Say the ex-div is the 15th. Everyone will get their dividend to reinvest on the 14th. Same pattern at the end of the month. That works. Wait, so are they going to get it? Are they going to get it in time to get paid the next dividend? Or are they going to get paid the day after and then they'll be buying the dip potentially with the cheaper one? So the ex-dividend is the 15th. Everyone will get their dividend reinvest on the 14th. Same pattern. Okay. So yeah, everyone's going to get, that's kind of cool. They're going to get paid just in time to buy more shares. That's fucking evil genius right there. Because if people are using drip, they can anticipate a bunch of new drip shares being purchased just in time. People are going to be more, well, I don't know if that's evil genius. Is it more genius to have it the next day to dampen the dip so that it goes back to par quicker? I guess it would piss people off if they got paid one day late and couldn't buy more shares with it before the dividend. But man, that's going to rack up compounding. Yeah, this is going to be fun. It's going to be fun to watch. If you sell, you do not get the next dividend. If you sell within how long? All right, these are expiring today. How much buying power do I have? 38. I've got $20. All right. if I don't want these to get called away, let me see. Oof. So these are probably getting called away in 2 weeks. This one, can I roll? This is $12 in the, or 12 cents in the money. I'm sorry, 52 cents in the money. So can I roll this for a credit? Not quite. So let's just cover it. I basically broke even on this because I sold it for 65. I can buy it back for 54. And this is the crazy part about options is I actually lost this bet, but the price of CLSK was high enough that I earned so much premium that my break even is 1235, and it's above my break even. So this is it's technically a winner and a loser at the same time. Um, so even though I didn't capture all of this, the price went down, but it didn't go down so much that I'm not able to capture some of it. But if I buy this to close, that's going to put me into margin use. Let's see what it's going to cost me. Well, no, I'm sorry. If I close it, I'm going to get the $1,200 in collateral back. So that's fine. And then I can use that. What's it going to cost me to roll this? If I roll this to next week. To roll for a credit, I have to roll to 1550. So I could roll it up 50 cents. Maybe I'll just do that now. This is 60 cents in the money, which means I'm only actually getting, what, 70 cents of extrinsic, which is actually pretty good. It's still 4 or 5% of the underlying. 0.17. Okay. Those shares are still in danger, but I did roll for a credit. And I raised my strike by 50 cents. All right, so now I have $37. If I roll this, I could roll this down to the 1250. That's 5 cents in the money. So this is like worth 63 cents. That's actually pretty good. That's like almost 5% returns. So what the hell? Might as well. Wait, that was at high fill. Let's do 0.11. You know what? I could have just taken assignment on this $12 CLSK put. Why didn't I do that? And I could just turn around and sold a covered call for Monday. On Monday, that is. Guess it really doesn't matter. Premiums are basically the same. All right, so my brother-in-law and I will watch this one. This one needs to be rolled. I'll tell him about that. If he's not at work today, we'll do that. Otherwise, I'll hit him up next week. And then this is 28 days left on the Strive put. It's worth less than half of what I sold it for. So let's roll it from 529 to, should I go all the way out to 48? Let's look at 42. I'm guessing the liquidity sucks ass here. 50 to 70. 60 to $1. Yeah, it's better on the monthly. All right, this is $12. So I could roll to the same strike, get 80 bucks, 70 bucks. Or let's roll the strike up and try to capture at least as much as I sold it for in the first place, which was what? And 27. Might not be able to get all the way to that. I'd have to roll to the 14 to get that. Let's do 13. $0.10 bid ask spread here, 15 there. Yeah, it's fine. All right, that gives me $60 of buying power. Plus, instead of buying the shares of prefs, I actually started storing my dry powder in strategy itself. What's my cost basis on the single solitary share? 166. So that's up a little bit. That's nice. It's up 7-8%. What did I say I have? I have $60. Yeah, that's not enough to buy another share anyway. So we'll do nothing. I think that's good. Sandeep says strategy ripping. Glad I closed out the 177.50 calls. Right on. Yeah, hopefully this will just continue to soar. And hopefully I'll have to continue to struggle keeping these under control. Now it is May. So we're getting close to the sell in May and go away annual event. Don't know if that whole cyclical shit rears its ugly head again this year, but we'll see. All right. Appreciate everybody for tuning in. Be good, Joe.